a term that you introduced, which is called equity anxiety premium. And you talk about anxiety and stress in a couple of articles. Can you talk about that? What is an equity anxiety premium and how that can help us get better investment results?
Now, we can't know about the future for sure. So the fact that stocks have kind of always outperformed bonds over the long run does not mean that they always will in the future. But we do think that it's pretty conclusive that over, say, a 20-year or longer time frame, you are very unlikely to make more money in bonds than in stocks. Why is it that investors who purport to have a long time frame, why is it that they also demand to earn on the order of 4 to 5% more per year in stocks? The reason is because it's terrifying to own stocks, right? To really put all this collective wealth that you've generated over the course of your life and put it to risk in the stock market and have moments like the 35% decline over 4 weeks that happened in early COVID. These are terrifying things. This is people's life savings. If you weren't experiencing anxiety last year, then you weren't paying attention, right? Over very long time frames, investors can't expect to generate premium returns to bonds with very little risk of that not happening. You need to manage your anxiety over that time frame, and the markets pay you healthily to do that because most people are incapable and of actually managing your anxiety.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money, how to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, investor, and a founding partner of Sicard Associates, a boutique investment firm founded in New York City. Join me on this quest to unearth the wisdom of the ages. Welcome, everyone. I'm so glad you're tuning into my podcast. For your convenience, the show is available on a multitude of platforms, including Spotify, Apple, Google, Audible, and many more. If you want to keep up with all new episodes, and there's so many more in the queue, make sure you subscribe and please do share it with friends and family. Review it and rate it if you can. Every little gesture matters, and I thank you for it. If you'd like to know more about me, or if you're interested in getting in touch, simply Google my name and it will lead you straight to my website. There's a contact form there, or check notes to this episode for links. I love hearing how you listen to my podcast on your walks, hikes, alone times, drives, trips, and more. I trust that my guests and I are a wonderful company on those adventures. I also enjoy reading how some of you are rehearsing and answering some questions that I ask my guests. I love hearing that. If you're new to the show, please scroll down and check out all the amazing guests I've had over the last few months. If you are serious about investing, money wisdom, wealth, and living a better life, you'll find plenty of episodes with some incredible ideas. For those who enjoy reading thoughtful pieces, I regularly write articles on Substack, which I'm sure you'd find insightful. Find me there and follow me as well. Finally, I'd like to mention my latest book, Crisis Investing. It's a collection of 100 essays that I penned for our clients during the tumultuous times of the global COVID pandemic. These essays are both timely and timeless, providing a unique perspective on navigating through crises. They were never meant to be published, but here they are available to you. Please find the book on Amazon. The book has already received considerable recognition and much love, ranking among the top releases on Amazon in its initial weeks. Thank you for your support and for being a part of my listener community. Now, without further ado, let's dive into today's episode. I've been an avid reader of Sean's articles for many years. Sean and his team have a very thoughtful way of presenting sometimes not so intuitive or easy investment concepts. Sean, together with Todd Wenning, have been regularly sharing their experience and knowledge for writing. I highly recommend checking the episode notes for links and looking up their work and articles. Sean Stannard-Stockton is President and Chief Investment Officer of Ensemble Capital, which he co-founded in 2004. Ensemble manages $1.5 billion on behalf of approximately 240 high net worth families and institutions. Their core equity strategy is a focused portfolio of 20 to 25 competitively advantaged companies. We talk about Sean's childhood and upbringing, exploring how it influenced him and paved his career path to investing. And paved his career path. We discuss Sean's article on value, growth, and intrinsic investing. Sean shared insights into the intriguing concept of equity anxiety premium, explaining how premium returns come from the successful management of anxiety. We touched upon the idea of equity duration. Sean elaborated on how stocks can be viewed as bonds, and he also shares with us lessons from the Nifty 50 stocks of the 1970s. Sean discusses his experience with COVID-era pandemic investing, reflecting on the unique challenges and insights from his perspective during this time. Sean shares his thoughts on an interesting theme that he's touched upon in his writings, the consistent underpricing of wonderful companies in the market. We discuss portfolio construction in detail, exploring topics like the number of stocks, position sizes, turnover, holding period. We also talk about remote work and Sean's firm's experience working remotely. To conclude, we talked about Sean's personal and professional definitions of success, getting a deeper understanding of what drives and motivates him. Stay tuned until the end when we discuss benchmarks and outperformance. Please help me welcome Sean Stannard-Stockton. All right. Well, hello, Sean. It's nice to see you. How are you?
Very good. Thank you so much for having me today.
Well, it's lovely to see you. You know, I'm a big fan. My team and I have been reading your newsletters for many years at Seacard Associates. There are big overlaps with the way we think, and it's nice to know that there are people out there in the world that think like us and have a similar approach to investing, patient, disciplined, and we look at the actual businesses. And I learned a lot reading your articles, and they brought some sense of discipline into the thinking that we have, and it's been an inspiration to follow your work. I want to get started right away, if you don't mind, and I like to ask my guests about their childhood and upbringing, and I'm curious how that time led you eventually to the career that you're on. And I'm always curious about the discovery of investing. How did that happen for you? How did you discover investing?
Until the summer after my freshman year of high school, I wanted to be the second baseman for the San Francisco Giants. I mean, that was just the absolute goal, no doubt about it. I never even had, the slimmest chance of achieving something like that, but I didn't realize that till I got to high school. And there was a summer after my freshman year, and I was on a road trip with my parents, who were both in the East Coast. And we stopped at a bookstore way back when they had bookstores. And somehow I ended up grabbing a book off a display case that was about stock picking. And it was written by a teenager for teenagers.
Uh-huh.
And in retrospect, I realized it was a terrible book. It basically was like a get rich quick scheme sort of book written by someone who didn't know what they were talking about. But it was the first thing I'd ever heard about investing and this idea that there was this incredible game that was very lucrative and very interesting. And so as I went through high school, I started learning more and more about investing and went off to college, dead set on that's what I wanted to do. So that was kind of what led me into investing. And it was interesting because I really had no exposure to investing outside the rest of my life. My father was a sociologist, my mother a psychologist, and I didn't have any exposure to the investing world other than just my own discoveries as an individual.
But those two fields, sociology and psychology, can be really helpful in the investing world, don't you think? So maybe you were being shaped slowly to becoming an investor, not knowing about it.
Yeah, no, I think that's right. One of my favorite books about investing I discovered very early on is by Robert Hagestrom, who has chronicled many of Buffett's works. But one of his books is called Investing, the Last Liberal Art.
Mm-hmm.
And he argues that many of the most important kind of cross-disciplinary lessons investors need to learn come from the humanities. And from my way of looking at it, if you're investing in businesses, not just trading stocks around, but you're investing in businesses, you're investing in groups of people who have collectively come together to create something of value. And what is that other than sociology and psychology, right? What are we all trying to do? We're all trying to figure out how are people going to behave in the future? How are the people at a company, how are they going to behave? How are their customers going to behave? How are the people at their competitors going to behave? All of these are just people, groups of people. And I completely agree that thinking about investing through the lens of humanities and all the disciplines of humanities is really key to what we do.
I like what you said, and sometimes I write about it, how it's a people's business, because on one side, we know the clients whose money we manage, and it's a huge responsibility. It's mostly families, multi-generational wealth that we manage. But on the other side, we know the people that are running businesses whose stocks we happen to own. So on both sides, you really think about people, their actions, their behavior, their emotions, and incentives, what drives them, what scares them, and so on. So I think there's a lot to explore. I'm curious to talk to you about value, growth, and intrinsic investing. There are quite a few articles that you talk about the difference between value and growth, and is there one or there isn't. And you have a beautiful quote from Charlie Munger, and I'll read it to you. I'm sure you remember it. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns, even if you originally buy it at a huge discount. There's so much in this quote to unpack, but there's this ongoing battle. Are you a value investor? Are you a growth investor? And we both know that it's not fair to look at it that way. Can you talk about your perspective?
Yeah, the only value of a stock is your pro rata claim on the cash flow that the company is going to generate in the future and be able to distribute to shareholders. Whether it decides to do that with that cash or something else is kind of a secondary question. But that is that cash. That's what you're buying. That's what a stock is worth, right? The problem is that all that cash is in the future, and we don't know how much it's going to be, right? Mm-hmm. But unless you're investing in some on the verge of bankruptcy company that might be liquidated or some sort of specialized asset play or something like that, most all investments that we all talk about and focus on are they generate cash in the future.
Right.
And so when we talk about valuation, whether something is cheap or expensive, we tend to use current results as some proxy, saying, this is some multiple of some current results or maybe next year's result. And that's can be useful for thinking about investing, but it doesn't tell you anything about the actual value of the business or determination of value is a business's future cash flow and whether you're paying less than that today. And that's unknowable and unmeasurable, right? Mm-hmm. It can be estimated, but you can't objectively say something is expensive or cheap. And so the way we think about it is we're looking for businesses that have enormous cash flow production ahead relative to their current price in the market. And sometimes that's businesses that are producing high levels of distributable cash flow yield right now, right? Mm-hmm. What you might think of as a cheap stock, right? Maybe it has a low PE ratio. We have stocks in our portfolio that have, low double-digit PEs, and last year some of them got down to single-digit PEs, and and then we have other businesses like Netflix that we've owned for going on 7 years now, and throughout that ownership period, there was a lot of people talking about they called it debt flex and talking about all the cash it was burning, right? And yet today, you look at all the streaming, Netflix generates enormous cash flow, and nobody else does, and collectively, Netflix is running away with all of the earnings and cash flow in streaming, right? And so was it cheap when we bought it? Was it expensive? You can have all sorts of arguments about that, but it's that future cash flow that matters, not what you're buying at the time, right? And so when I think about my own business at Ensemble, where I'm the majority owner and one of the co-founders, it's worth the cash we're going to produce in the future. It's not worth some multiple of last year's cash flow or this year's cash flow, and so as we think about value and growth and intrinsic investing, it's about understanding the intrinsic value of a company, the cash is going to produce in the future, the protective layers, the competitive advantages that can give you some level of assurance of that forecast. And then comparing that to the current market price. It's a simple thing. It's hard to get right, but it's pretty straightforward.
You mentioned something that I found really interesting, Sean, that initially when you look at an idea, you don't even look at the valuation sometimes. Correct me if I'm wrong, but that was my impression. So you're curious about the business, and the valuation kind of the second thing you look at. Can you talk about that? Because a lot of people get turned off by the valuation. They wouldn't even consider looking at the business.
Yeah. So for us, we spend an enormous amount of time seeking to understand the companies in our portfolio, and we often own them for 3 years or 5 years or 10 years or longer. And so what we're trying to do is really understand the business. And if it was possible to kind of do a quick back of the envelope math to get you some sort of valuation that was even in the ballpark, well, what are we all doing with all this research? Why not just use that back of the envelope? If it's an even decent proxy for real value, right. Gosh, save a lot of time for yourself, right? And so the idea that you can have an opinion on valuation before you've actually done the work to understand the business seems totally nonsensical to us. And we do think it's true that, on average, if a company's trading at, just to make up some numbers, under 20 times earnings and it's growing at a double-digit rate and it's producing lots of free cash flow, like it's probably on the cheaper side. But that's such a generalization. And we're only trying to own 2025 stocks. A lot of times, businesses that we own, the reason they're cheap is they don't appear cheap, right? That if you could just go out, find stocks that were obviously cheap on the surface and then be right about that assessment. I mean, all of us are just spending way too much time on this business, right? And we should just be just looking at some top line numbers. So for us, it's not that we don't care about valuation. It's that we think that an assessment of valuation is impossible before you've done really significant work. And so we try not to bias ourselves by using some sort of simplistic assessment of valuation as a screen on the way in. And instead, we're looking for great businesses. But partway through the process, sometimes you start to say, this stock's looking pretty expensive. I'm going to deprioritize the work that we do on this one, once you've done the work to have at least a partial opinion.
We think of it as building a wish list of businesses we would like to own at some point, and then looking for an opportunity to buy it, which leads me to the second question that I have for you, a term that you introduced, which is called equity anxiety premium. And you talk about anxiety and stress in couple of articles. Can you talk about that? What is an equity anxiety premium and how that can help us get better investment results?
Sure. So, the kind of academic theory for why stocks generate higher returns than bonds is because they're more volatile and they bounce around a bunch, right? And if in fact, the goal of owning a stock was to make money in a 6-week or 6-month or 1-year time frame, well, then volatility is kind of relevant because volatility is going to control your returns. Like there's almost no correlation between valuation and 1-year forward investment returns, right? All this work that we all do on valuation is trying to achieve kind of multi-year, appreciation premiums, right? It's for a 1-year period. That's just the wrong way to pick stocks. It's not the driving factor. And so in thinking about the longer term, and this is the math we went through in the post you're referring to, is that most all investors can know that over long time frames, say 20 years or long, there's almost no instances where stocks have underperformed bonds. Now, we can't know about the future for sure. So the fact that stocks have kind of always outperformed bonds over the long run does not mean that they always will in the future. But we do think that it's pretty conclusive that over, say, a 20-year longer time frame, you are very unlikely to make more money in bonds than in stocks. And therefore, owning bonds almost locks in risk over a 20-year period rather than avoiding risk. The path will be slow, but you won't get anywhere relative to stocks, right? And so what is the risk? Why is it that investors who purport to have a long time frame, why is it that they also demand to earn on the order of 4 to 5% more per year in stocks? If it's almost a sure thing, they're going to do better than bonds. Why such a high premium? And we think the reason is because it's terrifying to own stocks, right? To really put all this collective wealth that you've generated over the course of your life and put it to risk in the stock market and have moments like the 35% decline over 4 weeks that happened in early COVID. These are terrifying things. This is people's life savings. They're the accumulation of all of their efforts over time to create value for them and their family, and putting that at risk and having bounce around the stock market is terrifying, right? And we talked in the post about, if you weren't experiencing anxiety last year, then you weren't paying attention, right? To not be stressed out last year is not a mark of, you're just, has such control of your emotions. It's to say you were not paying attention. I think that's the case. But over very long time frames, investors can expect to generate premium returns to bonds with very little risk of that not happening. And therefore, what it is that they need to manage, if in fact they're long-term investors, is actually like your retirement money or whatever, you need to manage your anxiety over that time frame. And the markets pay you healthily to do that because most people are incapable of actually managing your anxiety.
Do you see this as an additional source of opportunity? Going back to Charlie Munger's quote about some stocks trading at a big discount at some point. In moments of distress, a panic, and it could be a market-wide panic, but it could be one individual stock that people panic around. A couple of missed earnings, a product recall, management change. We've all seen all kinds of things that seem like a disaster, but it's not a permanent damage to the business. Do you see moments like this as an opportunity to go in, keep your anxiety on hold for a second and buy something at a bigger discount? Is that something that you also consider?
Sure. I think it's just, it's all opportunistic, right? So for instance, in March of 2020, we really added to our positions in the home builder and fast food company. Those stocks were tumbling, and we just believed that as scary as the pandemic was and as potentially devastating it was to the economy, that in 5 years, you're going to still need houses. You're still going to be eating out, and that they're still going to desire relatively fresh, healthy fast food compared to the frozen beef burgers that everybody else offers. And so taking advantage of that, is part of what we do. But I think where it comes into play more, we aren't necessarily investors who are seeking to jump in and grab a stock in the midst of crisis and then catch the rebound as the crisis passes. We're seeking to own businesses for a very long periods of time. And when you own a business, even the best businesses for a long period of time, you will pass through multiple crises, right? All of our best investments have had some period of really significant underperformance at some point over the long time that we own them. And so I think that's where most of the alpha that we generate comes from, is not so much arriving new on the scene to a company in crisis and buying shares at the cheap. We do that sometimes, right? But I think more of it is that when a business that you're going to own for 15 years and generate great returns, 4 years into that, it underperforms by 30 or 40% and people begin to write it off. And you have the fortitude to understand that the crisis that presents itself is real, but temporary, and that you hold through that and the value comes back. And so I think that's where that kind of anxiety management is most important for long-term kind of focused investors like ourselves.
So it sounds like it's more about holding on to it when it's really hard to hold on to it. That's what I'm hearing, because it's very tempting to exit and move on in moments like this.
I think that's right. I mean, buy and hold sounds so easy, doesn't it? You just buy a stock and just hold on for the ride, right? And yet it's not easy. It's incredibly hard, and it's not only that the business that you own may go through a crisis. It may be that the businesses that you own just kind of keep plodding along, doing fine, but really exciting stuff's happening someplace else. And you think to yourself, I got to go chase the exciting stuff. What am I doing sitting in these boring, executing businesses, so there's always a distraction. There's always a reason to trade. There's always something to move on to. And yet simple buy and hold, one of the posts that we wrote was that there's no such thing as buy and hold, because over the course of a decade, the businesses that you own are going to transform themselves. And, Buffett talks about something like, 70% of the capital in business will be deployed by the company that, while you own it over a 10-year period, and therefore it's been mostly transformed. And so, the sort of buy and hold that we do is buy, constantly monitor and analyze all day, every day, week after week, month after month, year after year. And through all of that, we often will hold a stock but we'll change our position size, from time to time. Businesses get, you have more or less confidence in business at different points in time. And just because it was a great business when you bought it does not mean it will stay a great business the whole entire time you own it. And so sometimes when a crisis comes along, you need to recognize this crisis is real.
It sounds like your exit strategy that I'm sure we'll come back to, but I wanted to ask you about emotions and anxiety from a perspective of whose money you manage. And I had quite a few conversations on this podcast with quite a few guests, including Guy Spear, about managing your own money, managing your family money, and then managing other people's money. And it's not that one is easier than the other. They're very different experiences. But what I've learned managing money for other people, that my emotions might be in check, but I have to take calls from clients and then absorb their emotions at times of distress. Can you talk about that experience? It's even harder to hold on to certain investments when it's not just your own emotions that you have to address.
Yeah. So one important thing to know about Ensemble Capital is that we're a wealth management firm serving private clients. We also have a significant amount of institutional money in our equity strategy, but we built the business sitting down with husbands and wives and individuals in the tech sector here in Silicon Valley who are looking to build wealth and reach personal financial goals. And I think for me, what I've taken away from that is this idea that the returns that matter are the real life outcomes in people's financial lives, and it's really easy to get caught up in your alpha versus your benchmark and all these different sorts of things. And those are not unimportant, but at the end of the day, we're managing money on behalf of real people who this is their real wealth that is critical to them living the lives that they hope to live. And so, I think keeping that in mind, can be, anxiety producing, like the responsibility it carries, but it also can keep you grounded and remind you that, like, what is it we're trying to do here? We're not trying to dodge a bad earnings report. We're not trying to minimize a week or two of volatility. We're trying to build long-term wealth, protect and grow wealth of the families and individuals, as well as institutions and foundations and nonprofits that we manage money for. And so for me, I think that one of the things that we've become somewhat known for is the way that we talk about investing in very kind of digestible, easy to understand ways. So we have very sophisticated clients, and we also have clients who are not particularly sophisticated as it comes to financial markets. But our approach is to say, let's treat everybody like the intelligent adults that they are. And if we can't explain to people what's going on in the market and the economy and their portfolios in a way that, a reasonable, intelligent, fully educated adult is able to process, then we aren't doing a good job with our communication. And I think that's really key because we had love to talk to about at some point during this interview is this idea that it is not actually the returns that our strategies generate that will leave a mark on the world. It's the returns that we generate on client capital that makes a difference. And not every manager with a great record is able to take all their clients along for that whole ride. It's easy for clients to come and go at the wrong time and perform even a great strategy.
There was a study, and I don't know if it was Peter Lynch that shared it, that the average dollar invested in the fund is not exactly getting the returns that the fund is getting because people come and go. There are multiple studies, but I think Peter Lynch was one of them that quoted it. And it's really interesting what you mentioned, having everybody on board through the entire journey with you so that the actual returns that the capital gets are close to what you think you're getting in the process. We talk about the capital that we manage as the capital that the clients don't immediately need. They're in a very comfortable financial situation, but it's also the money they can't afford to lose. So if it's inherited money or money created in their lifetime, it might be close to impossible to replicate it if it's lost. And it sets a certain framework in terms of what kind of opportunities we're open to and what kind of risks we consider just unacceptable. So I see some parallels with the way you think about it and remembering that there are real people behind the capital. I think that really helps. I want to ask you about a couple of articles that you wrote about duration, and you compared equities to bonds, and you touched on it a little bit, and then you have some lessons from the Nifty 50 stocks of the 1970s, and maybe you can remind the audience what it was all about. I find that period fascinating. My senior partner, Francois Sicard, started working in 1969, and I always ask him about the 70s. I think there's a lot to learn from that period. But let's talk about this concept of duration and stocks versus bonds and what happened with the Nifty 50s. And it seems like the story repeats itself every 5-10 years in some other way.
Okay, so just for listeners, let's just first define duration in a straightforward way, and we'll use bonds. So, right now, you can earn 5% in a short-term bond. But if you buy that bond, you are only locking in that rate of return for 1 year, right? But you can also buy a longer term bond, say a 10-year bond, and maybe it earns 4%. So you're actually going to earn less by locking your money in for 10 years, but it's also locked in for 10 years, right? And so the duration of that bond is longer. And what matters about that is that the more interest rates move, longer duration bonds will change in value more, because whatever that rate is, it's locked in for a long period of time, right? And so if you have, if you were, God forbid, you bought a 10-year treasury at 0.7% at the end of 2021, you've locked that in for a decade. And now that you can go out and earn 5%, just in money funds, well, right. It makes sense that 10-year bond has fallen a lot in value. So duration is just one of the kind of core concepts in bonds. But remember, we said earlier that the only value of a stock is the future cash flow that its company is going to produce. And that's the same with bonds. The only value of a bond is the future cash flows, the coupons and the maturity payment that are going to be created. And so a stock has a duration just like a bond has duration. It's just that in the case of a stock, we don't know what the terms are. We don't know how much cash is going to be produced or when exactly, right? But that doesn't mean that there is not duration involved. And so what we talked about in that post was this idea that a business that is going to generate, let's just use an example, like a consumer staple, like a Procter & Gamble sort of business, right? And it's going to produce slow growth, but stable cash flows. Mm-hmm. And then you have another business, an early stage business that maybe is only break even at this point in time, but is growing rapidly and could be expected to generate a lot of cash out in the future. Well, just like a longer term bond, a business that's going to produce more cash flows further out in the future is a longer duration business, right? Complicating that with stocks is that the price you pay for a stock changes the duration as well, right? So if the growth business you pay a very low price, that can shorten the duration as well. But the core point we were trying to get across is that changes in interest rates and changes in perceptions around how long interest rates are going to stay at a certain level impacts bond values. Like that's just a self-evident statement, but it also impacts stock values. And so we introduced this idea that last year was a period of time in which duration got extended duration shortened from investors' perspective. So investors said, I don't care about 2045 earnings anymore, like so many people did in 2021. Suddenly, I just want to know what you're going to earn next year, right? And if you're going to miss this quarter, but next year's going to be fine, I don't want to wait that long, right? And so we saw this change of behavior. And from our standpoint, whether we're invested in a low PE kind of quote value stock or a high growth, quote growth stock, at the end of the day, every business we're investing in or business that we think are going to create future value, right? Businesses that are relentlessly reinvesting in the future, right? Who take the cashes they get today and don't think themselves, oh, great, how much can we just put this away? But companies that say, is there a higher, better use for this cash? Like, we'll give it back to our shareholders if we got nothing better to do. But if we can generate returns that are above just in the S&P 500, why wouldn't they, right? And so we want our companies to be reinvesting in that way. And that means that we're focused on kind of future oriented, or you might think of like long duration businesses, during the Nifty 50 era, this all played out very dramatically. And what your colleague who worked at the time will tell you is it's not just that there was a year of bad inflation like we had last year. And it wasn't just there was like 2 or 3 years. There was a decade of ongoing double-digit inflation and multiple recessions. It was a disaster of a decade. And so stocks got down to single-digit PE ratios, and a lot of growth stocks just absolutely collapsed. So what we showed in that blog post was that if you had bought the Nifty 50 at its peak, it would have generated the same returns as the S&P 500 over the next 25 years, meaning that those stocks were not overvalued, despite the fact they collapsed so much. What happened was they collapsed as people got worried about high inflation lasting for a very long time. And as that was resolved, even though it took a decade, once it resolved, the valuation of those businesses came storming back. And the contention we were making last year was that these growth stocks that had collapsed so much in value last year, if inflation was going to stay high for a decade, well, then they probably were not going to come back anytime soon. But if you believed like us that this inflation and these economic challenges that we face today are nothing like the 1970s, they're very serious in their own way, but they're nothing like the 1970s. That there was no particular reason to think that you would have a decade of high inflation or even worse, stagflation, that there was huge opportunity in those growth stocks last year. And we continue to think that's.
So in moments like this, let's say that you were sitting there in 1971, 1972, what would you do in terms of being in stocks or in bonds or in different stocks, or would you exit the market? I'm thinking of Warren Buffett, and with somebody I had a conversation about Buffett's false retirements, how there are moments where he would just say he's out. He closed the partnership, but he didn't actually leave. And I'm wondering what I would do in moments like this, when you see that there's too much hype, the valuations are high, there's some risks coming in. How do you navigate through an environment like this? I feel like the 70s, as you said, were very peculiar, and we haven't lived through anything like this since, at least in the US.
So I think there's kind of two reasons why an investor might kind of get out the way you mentioned. I don't think it should ever be about observations about what the is going to do, unless, of course, all you care about is buying the market, the passive fund, right? And in our case, we're just trying to buy 2025 businesses. And in my experience, I think just thinking about it rationally, there's very few market environments in which an investor can say, I just can't find even 20 to 25 attractively priced stocks to them. It doesn't necessarily matter if the market's expensive. There are always values, and we weren't running this strategy in 1999, 2000, but there were lots of the dot-com bubble and all this collapse, but there was investors like David Draymond, who was at Scudder Investments, was like an early hero of mine. His stocks did great. He owned these super low, PE banks and home builders and things like that. So there's always opportunity in the market, I think that the two environments in which opportunity can dissipate dramatically is true bubbles, right? Like we had in 1999 or 1929. And then periods ahead of really disastrous economic periods, right? Like if one of us had a crystal ball and we could have told that the financial crisis was going to come in 2008, well then, get out of the market ahead of time, right? And same thing with early 1970s. If you had a crystal ball that could tell you that there was going to be runaway inflation for a decade, well, you're going to be well served to get out, right? But we think that latter case of anybody kind of having that crystal ball, it's just not real, right? I mean, we all know, stories of people who made some big call and got it right. And there's famous people that maybe they got 2 in a row right. And then they become really famous, right? But somehow they never get the third one right, And so we pay a lot of attention to macroeconomic environment to understand the context in which our companies are operating. But we're never going to say we're going to get out because we're really negative on the economy. We just think it's not an actual feasible achievement to strive for. But when we can't find attractively priced stocks, we'll let cash accumulate in the strategy, and that's just what it is.
I noticed this phenomenon with quite a few investors that have been in the business for 50, 60, 70 years that I got to meet over time and spend time with, that you can reach a point of being scared out of the market. You've seen so much bad that has happened. And I'm thinking even of Ben Graham. There's a story of him that in the last years of his life, he was pretty much out of the market. And it might have been a personal decision. He didn't have to make more. I don't know the context, but it kind of rhymes with this idea that if you've seen so much bad, at some point you panic. And I'll ask you about COVID in a second, but I took calls in March of 2020 from really experienced, seasoned investors that I admire that have been in the business for 30 years. And they were making an attempt to get out, and some of them got out at the worst of times. So it got to them in a way that pretty much derailed them, their business and professionally and on a personal level, because they missed out on a massive recovery that followed. Can you talk about that? Getting scared out of the market because you've seen so much bad, or somehow you're immune to it.
Yeah. So when you're a brand new investor, it's really easy to be disciplined and to say like, hey, the stock's trading at a P of 10. That just must be cheap. And so you buy it and it goes up and you say, I bought a cheap stock and it worked out. But what you didn't know at the time was all the very valid reasons why the stock was trading so cheaply, right? So I'm talking about an early investor who is naive, right? And then you get to build some degree of expertise or wisdom or understanding of how businesses go. And as that goes on, I think what actually happens is you become more and more aware of how uncertain the future actually is, And so I think that sophisticated, experienced investors know how bad things can actually go, right? And that is real, right? But the way I think about it is I look back over the last, say, 75 years since then, World War II, and occasionally I'll have a client say like, well, I know the average return's been 9% or whatever the last 75 years, but those times are gone. The good times are over. I just don't expect we're going to have that. If we do 5 or 6% a year over the next decade, I'm going to be happy because, we benefited from so many tailwinds in the past and those are all over now. And then you look back at the last 75 years of the economic and, human wars that have been visited upon this earth, right? I mean, cold wars and hot wars and pandemics and decade-long periods of inflation and crashes and technical crashes like 1987 that people still don't fully understand. And you realize that Oh my gosh, those returns were generated despite all of the challenges that humanity faces in its attempt to kind of organize and create value over time. And that the future ahead will have all sorts of challenges as well. But if there were not to be challenges, imagine how incredible businesses would be. Imagine the advancements humanity would make, right? And so for us, it's not that we think, oh, things aren't going to get that bad. It's that we think to ourselves, even when things get really bad, over the longer term, if you're doing your job right, and importantly, you own businesses that get through the hard times to the other side,
Right.
it's gonna turn out okay. But all that being said, I managed money into the thick of COVID. I managed money into the thick of the financial crisis. And I think that in both instances, if you didn't understand that a global depression may have been in the offing, that you weren't paying attention. Those were not easy buys. It was not to say March of, your experienced friends who got scared out. It's because they were acting rationally. They understood that something terrible was happening all around the world. And we did not know what the outcome was going to be. Right. And so it's not, I don't think they got scared. I think that they rationally recognized the dramatic events that were unfolding. And they took an action that didn't end up being the right one. But it wasn't like, oh, they got scared and, oh, it just should have known everything was going to turn out okay.
I had a fascinating conversation with John Jennings, who wrote the book about uncertainty. And he makes a point how if we had that crystal ball that you mentioned in March of 2020, and you and I didn't know where the market will go, but we knew all about the COVID statistics, the deaths that will follow, the lockdowns, repeated lockdowns globally. If we knew about the economic impact, the people that got and lost their jobs, if we knew all of that, I think a lot of us would not choose to invest because the news was just so dark. But then there's the reminder that the stock market is not the economy. And that's what helps us continue to participate. I don't know if you have thoughts about it, but if we knew how bad it's going to be, I think a lot of us would have chosen to just exit.
I think this is a really important concept. That, if you gave me the Wall Street Journal from 10 years from now and there was no stock prices in it, it just told me everything that kind of happened. You would think that would just be the easy ticket to riches, right? That you would know what would happen. But you don't, right? So it's not even enough to know what's going to happen in reality. You also need to understand how stock prices are going to react. And it is so, there's so many complex cross currents there. I remember when the market was storming back in April, May 2020, and talking to people who were saying like, this is crazy because clearly the economy is in shambles. But I think the way to understood at that time, if we just use the S&P 500 as the proxy, was that small and medium-sized businesses were just being shut down. They basically been ordered by the government, you must shut down, and only the big companies are allowed to operate. And so they were just sweeping up wealth, right? And so if you thought about the market and you thought, well, this means like companies in aggregate, that's not what the stock market is. It's 500 gigantic companies, right? That have the balance sheet and the wherewithal, that have the systems to be able to implement COVID protocols in rapid order, And so it was really something quite different than just understanding the economy. It was to understand what those businesses.
So I have to ask you about COVID and that time and your experience investing for the pandemic. But before I ask about that, your firm was remote ready before COVID happened. Can you talk a little bit about that? It's fairly unusual in the investment profession, and Seacard Associates right now benefits quite a bit from being remote in many ways. But it wasn't something that was common at the time in 2020. Can you talk about that? Why you decided to be remote ready, and then the transition to working fully remote, and then market experience that you had?
Sure. I mean, it certainly was not in anticipation of a global pandemic. I can tell you that. For us, it was just, we were, in the San Francisco Bay Area, and the traffic was getting worse and worse. And we started to struggle just to hire people who lived in the Bay Area. Just the traffic within the Bay Area had gotten too bad. And so we started experimenting with remote work. And I was actually kind of the most hesitant. I was really worried about kind of the culture impact and kind of free flow of information, all that sort of stuff. But we just started off and we told everyone in the firm, you can work one day remote without any kind of permission from your managers, put it on your calendar. But importantly, you have to get your work done. So you need to work where you need to work to get your work done. You can't, if you're a client facing person, you can't say, well, Tuesday's my remote day, so I can't be with the client. Well, that's not what we're doing here. We're doing our work, but if it, you can choose where to do that work if it facilitates getting the work done. And that worked fine after a year. And there was like no negative repercussions. And then we made it 2 days a week. And then in the third year, we just told people, you know what, just get your work done wherever it needs to get done. And that might be quite different for someone who's working in operations versus a client facing advisor and all those sorts of things. And so we came into COVID operating in a way that was what we call hybrid today. But it was very much directed less through some sort of policy around everyone in the office 2 days a week or something like that. And much more around work where you need to work, get your work done, and sometimes it can be much more productive to be remote. And sometimes it can be much more productive to be in person. And I think in-person relationships and interactions are very important elements of being human and being part of a team. But then we just shut everything off. I mean, San Mateo County, where our offices were in 2020, was the first in the nation to go into shelter in place.
Mm-hmm.
The order came out at like noon, and I directed the entire team, said at 1:00, you log down. If you haven't gone grocery shopping, go stock up. And we're not going to be coming back, right? And not for a while. And so we just operated that way for a year and a half. I know different parts of the country, it was like 6 weeks later, people were back in the offices. That just wasn't the case in the Bay Area. If I had offered to meet with a client in person, 3-4 months after COVID hit in the Bay Area, they would have fired us for, not thinking right. It was, so there was no need for us to kind of go back into the office in short order. But interestingly, we did move into larger office space in downtown San Francisco from smaller space outside of the city. And, I've had a couple people ask us, was that like a value investment? Did you get a great deal? And in our case, we were able to get the only vacant spot in a Class A building that we never could have gotten access to. And that's kind of my kind of value investing, right? It's not super cheap on the surface, but it's a super high quality asset that's not often available, and we were willing to acquire it, and so we use that space for group gatherings. We had a retreat in January, brought everyone in the firm together for 3 days, and we work there regularly depending on the work. But the default is not to say, go in the office and sit next to your colleagues. I know a lot of people are doing that today. And what are they doing all day long? They're on Zoom calls when their colleagues sit next to them on a Zoom call with somebody else, And so for us, this work that we do, it's very much knowledge work. It works well on a remote basis. I'm happy to go more in the details. But I also recognize that not all businesses are equity research, right? And not all business can operate remote. And I have no kind of grand conclusions what everyone else should do.
No, I agree with you, and that has been our experience. And we were remote ready, not knowing we're remote ready. So the senior partner, Francois Sicard, he lives in multiple places, and he wasn't always in New York anyway in our office. And we would set up Zoom before anybody knew what was Zoom. We were doing Zoom calls with him and with certain clients that are not based anywhere near. And then we had cloud services and all kinds of solutions that would make it possible to work from anywhere. I was on the road seeing clients. And then when COVID happened, we just closed our laptops. We walked out. We left the office for a long period of time. And we had not seen each other in person for I think almost a year. And then we started to see each other, but continued to work remotely. And clients embraced it. I had some concerns because they were used to seeing some of us some of the time in person. And as you mentioned, quite a few of them were just not ready to see us for a while. And only recently I resumed some of my regular trips to see people in person and catch up. And I think it's as important in the business because there are certain things that get lost over a Zoom call. But the Zoom calls help in between to keep the conversation going. So it's been a fascinating experience. Years ago, I went to a digital nomad remote work conference, and I came back with those ideas to my firm in 6-7 years ago. And a lot of people told me that investment profession is an in-person at the desk kind of job. And I can tell that you agree that research work is something that can be done from anywhere as long as you remain productive. I want to talk about the market experience. What was it like for you? And everybody had a very individual, different experience of March of 2020. And I'm curious, were you surprised, shocked, ready to act? What was it like for you on an emotional level? And then also how your clients experienced that time, especially the beginning of it.
So I felt lucky that one of the analysts on our team is a very science-oriented guy, and he began following COVID stuff before it was dodged the downturn or anything like that. I mean, getting back to, even if you can predict what's going to happen, doesn't necessarily mean you know what stocks are going to do. And neither he nor I nor everyone in Ensemble believed we knew what the course of COVID was going to be. But it did mean that we were paying attention to it relatively early on. And there was all of the mocking of how everyone became like a epidemiologist expert overnight. And of course, none of us were. But this is one of the things about being an investor is that you need to get to understand or absorb the information from like a huge range of stuff. So during the financial crisis, well, we all had to go learn all sorts about collateralized debt obligations and things like that. And you know, then now pandemic, you learn about these things. And to me, you have to be very careful about how much you can know. There's plenty of people out there who thought they could do a crash course in epidemiology and forecast the pandemic, and they were wrong. But you could get to understand the range of potential outcomes and sorts of things that may happen, especially over time. You keep updating your understanding and your forecasts. And so, you know, for us, I think one of the really big moments for me that I remember so well was when COVID first jumped to Italy. And remember that, you know, in hospitals, there was just people dying in the hallways in Italy, and it was just pandemonium. And I had this huge LinkedIn network, right? Just from writing about investing and everything. And I did a quick search for Italy, and I managed to connect via Zoom call with a senior executive at a bank. And it was on a Sunday night. And he got on the phone with me and he said, Sean, the grocery store is closed on Friday, and I don't know if they're going to reopen on Monday.
Wow.
And that was the moment when I was like, oh,
it's different.
This isn't like, oh my gosh, some people are going to get sick. This is about society coming to a halt. And what is that like? And so the way we approached COVID in say this, during say the month of March 2020, when the market was falling so rapidly, is we just tried to say, okay, rather than think about what's going to happen, let's underwrite what would happen, what would need to happen to this business for them to actually run into some operating concern issue, like their cash flow comes to a halt and they don't have cash on their balance sheet, whatever that might be. Let's model that and decide, do we believe it's not going to get that bad? Because the goal here is to get to the other side. That's the only goal of that, right? And we exited one stock in our portfolio. It was a maker of parts for automakers. And it occurred to us that auto production was going to halt and had rolling bankruptcy across the auto OEMs. Mm-hmm. And that this mission critical, low cost parts player that had the great competitive advantages, those just might not matter at all if your customers are bankrupt and not paying their bills, you know, and we exited that, but we also added some new names, right? So we stayed invested, and the way I thought about it is the reason we do all this work in researching companies and trying to find companies that have defensible cash flow streams and are well run, all sort of stuff, is to say, we don't know what the future is going to hold. So we want to make sure that we're in businesses, have the tools to get through unknown crises, you know? And so what we did in the second half of March was just look and said, let's make sure, like, are we ready to ride these companies? Like, we're going into a storm and you can't jump out once the storm started, right? Then you just die in the waves, right? So yeah, you're going to have to ride through the other side. Are these the stocks that we're willing to ride? You know, like I said, we dropped one stock out of the portfolio, 25 companies, but everything else we decided just to ride through. And that ended up being the right choice. Not that every stock worked out. But, you know, we really didn't have any businesses in the portfolio that got, you know, devastated by COVID, with the exception of the online travel agency, whose stock recently has now performed, I think, just about in line with the S&P 500 since before COVID. And there's a business that went to negative revenue. They had more refunds than new collections in April 2020.
Unbelievable.
And yet we held it, and it held it ever since, because we didn't believe COVID would do a thing to change the human desire for travel. It's hardwired into our DNA, and we decided to hold it because we were saying it could be a while. But the good thing is they had such a great business model that they were able to operate without revenue for 18 months as the pandemic. And we just figured that was.
I like to say that I want to be the least wrong. I think a lot of people go into investing because they want to be right. And some people go into investing that I don't even think they want to make money. They just want to be right. And I think it's a dangerous place to be. And in moments like this, we were trying to figure out how can we be the least wrong? What kind of businesses we shouldn't own? What kind of businesses we can add to? And how we can participate in a potential recovery, even if it takes 3, 5, 10 years. And to me, in moments like this, I like to look at history. I love history and reading about history. And I had quite a few guests on the podcast that always remind me, if you don't know the answer, look up a history book. And I was reading a book about plagues, the history of plagues that we've had as a humanity. And one thing that I walked away, and I had more notes that at the time, was that each plague comes, or pandemic comes in waves. There are always waves, and they're very irregular where they peak in different parts of the world at different times. And I thought it's a very powerful idea because we're made to believe that this is over in 2 weeks. But that's not how any of the pandemics ever worked. And I was trying to imagine what it would be like for businesses to survive and manage through multiple waves of lockdowns that happen at different points in time. And that allowed us to, sift through some ideas and benefit from it eventually. But there are all kinds of things you can learn from history. And I'm sure you read quite a bit too, just to see the parallels of things have happened before. Not exactly the same, but there are some big similarities. You have a great remark in one of your articles that I wrote down and I really liked. You say how the market can consistently underprice wonderful companies. And we were just talking about some wonderful companies. Why is that? That market that everybody's so smart, reading everything, has access to everything, but the market still somehow consistently underprices some of the wonderful companies that you like to own.
So the market overall rationally prices stocks such that their growth rates will slow over time, right?
Mm-hmm.
And moderate, kind of converge with the mean. And that their return on invested capital, right? The returns they generate each new dollar invested in a company will also kind of converge with the mean over time. And what is a wonderful company, right? Well, a company that can buck that trend to some extent, that somehow it is not subject to mean reversion. What is mean reversion is to say to become average, right? So by definition, a wonderful company is one that does not just become average, right? And so if, and only if, you were able to correctly identify a wonderful business, a business that there's something about company, business model, the dynamics of the industry, the dynamics of the customers that allows the company to break very compelling trend towards mean reversion, then it makes sense that the stock would continually outperform, right? And of course, there are lots of other people looking for wonderful businesses. So sometimes you can find a wonderful business and it can do well, better than average, and the stock can still underperform. So it's not just as simple as saying just find wonderful businesses, full stop, right? You then have to quantify that wonderfulness, right? A business might be wonderful, but doesn't mean it has infinite value, right? And so I think where the alpha that we seek to generate comes from is much more about the competitive advantage period of a business, as opposed to how fast it grows or how cheap we pay for it, right? And if we getting back to our opening comments about kind of growth and value and what we do,
right?
The value investor says, I pay a really low price, and even if bad things happen, I'll do well, right? And the growth investor says, I'm going to find businesses that are going to grow really rapidly, and who cares about the price? Because everyone loves rapidly growing businesses. If it keeps growing rapidly, the stock's going to go up. And both of those perspectives are kind of right to a degree. And for us, we're trying to play a different game, which is to say, what are truly competitively advantaged businesses? What are businesses that there's something about the business that truly protects its future cash flows in some meaningful way? And if you find a business that's wonderful today and is super lucrative today, well, guess what? Their competitors and venture capitalists and owners of capital all around can look that up on Bloomberg themselves, right? So a business that has amazing profitability today, in my mind, is nothing more than a company with a target on its back, right? It's not a sign of it being great in the future. It's just a target. People are going to come after it. And so therefore you need to find businesses that have something about them that prevents other people from coming and stealing those profits. And if you can correctly identify those, right? And correctly is the key, right? It's one thing to find it, but then you have to be right. And that's hard. And we've been wrong plenty of times in our career, right? And so if you can figure that out correctly, then you're able to own the business for a long period of time as the market typically will only kind of extend forward its view of the competitive advantage period for a couple of years at a time. And it's rare that the market will actually price a stock understanding it's going to kind of stay wonderful for a decade.
That makes sense. I want to ask you about something that you mentioned throughout the conversation, but your big picture portfolio construction thinking. How many stocks? How do you think about the sizes? How do you think about the turnover? And you touched on it a little bit, but I want to come back to how you think about benchmarks, outperformance. I'd like to explore that too.
It matters a lot to us to outperform the benchmark over the longer term. It doesn't matter to us to construct a portfolio that replicates the benchmark in some way. In fact, if you're going to replicate your benchmark, you're likely to perform just like the benchmark, right? And if the goal is to perform outperform. That means to perform differently, right? So we have no constraints in our strategy that mandates that we have a certain amount in a certain sector or industry or anything like that. But we own 20 to 25 businesses. So on average, let's say 4.5 to 5% position size. Our max position size is 10%. At any given point, we often will have something in the order of 65% of our portfolio in our top 10 names. And we spent a lot of time, well over a decade ago now, kind of really thinking through the position size framework that we use today. And I think that position sizing is like one of the great unexplored areas of investing, right? Like all day, every day, people go on CNBC and tell you, buy this stock or sell this stock, but they never tell you how much, right?
They don't.
and this is actually one of the really key considerations. Someone can say like, well, I love Google. Great. Do you love it like it's a 2% position or it's a 40% position? Those are totally different points of view, right? And so, for us, there was kind of two drivers of where we ended up with this 2025 stocks. And we don't think it's kind of some perfect position sizing. It's just right for our strategy and for us as investors. So the first is that if you randomly select stocks out of, say, the S&P 500, what you'll find is that the volatility of your randomly selected portfolio will be very high if you only pick like a 3-stock portfolio. It'll be much higher than the market. But as soon as you get out to 25 to 30 stocks, the volatility of your sub portfolio begins to mimic the S&P 500, and adding anything more to the portfolio only diminishes kind of volatility or drift away from your benchmark by a little bit, very small amounts. And on the surface, that seems odd. Like, how could you just pick 20, 25 stocks out of 500 and yet achieve the same level of diversification? But think about political polling, which has gotten such a bad rap in recent years, except that, it's accurate to within like 1.5%. It's just that that's the margin of error in politics, right? And if you look at it, they only poll, like tens of thousands of people, and yet they get an assessment on hundreds of millions of voters, right? So it turns out that if you're randomly selecting, your sample size can be relatively small out of your entire sample, right? The number that you actually pick from. And you can kind of replicate the underlying trends, right? So there doesn't seem to be much reason to own many more stocks than that if all you care about is minimizing volatility versus the benchmark. And then the other piece of it is that there's only so many good ideas out there. Like the biggest limiter to our success is trying to find enough great, wonderful business that also trade at a reasonable valuation. They're just not super common, right? And so because of that, imagining trying to own 150 stocks like the average mutual fund does tells me there's no way you can know all those companies. There's no way that you can even believe yourself that they're all great investments. It's too many, right? I mean, nobody has that many great ideas. Even if you have a team of analysts, you just don't, right? And so for us, kind of 2025 is the amount where we capture the benefits of just raw diversification just by having a certain number of stocks. And yet we keep narrow enough that we have our money in our best ideas that we truly know inside out. Look, we get stock picks wrong sometimes. There's no doubt about it. But there's never once, that we're sitting around saying, we just weren't paying attention to what was going on in that company. We might have been paying attention and had an incorrect conclusion. But with this number of stocks, you and a small team can understand it inside and out. And to me, that's what the key is. Like when the chips are really down, when a stock is just puking and you're worried and you think you got it wrong, you have to be able to lean on, what do I actually know about this business? And is the stock price reflecting what I really truly know and believe about this business? Or is the stock price overreacting in some way? But the only way you can do that is to truly know your businesses, to live them and breathe them, to know everything about them. And it just seems implausible to do with 150 stocks.
No, I agree. When or how often a new idea enters the mix? So you have the 2025, you probably probably trim sometimes for various reasons, but a completely new character in the story. How often does that happen?
So we have about 10% turnover the companies in our portfolio. So about 2 to 3 new companies enter the portfolio each year, 2 to 3 exit on average. And you can look at our kind of over the long term, this, works out about 10% average holding period. And again, is at the company, not each share count, because on the flip side, we pay live at position size. And so we may own a business that we've owned for over a decade now, but we've owned different weights of that name all along the way. And so we absolutely trim stocks or add to stocks. And we are not just buy and hold and sit on our hands sorts of investors. I think the full turnover, as you would calculate on share count rather than companies in the portfolio, their strategy has often been about 30%, 35%. So we're turning over any given shares every 3 years. But if you think about the idea that stock prices are kind of, get out of whack with intrinsic value, but they revert back to intrinsic value over a period of time, and that's the whole basis for buying an undervalued stock, then you would imagine that over like a 3-year time period, some of that would occur and that you would therefore trade it out of stock. So we are aggressive in maintaining the position size we want, but in terms of actual companies that we own, it's more like a 10-year holding period with about 10%.
And they come and go. Benchmarks are quite a frenemy of the investor in many ways. And I'm thinking, you mentioned the position sizing. If you look at the equal weighted or the market cap weighted, and you mentioned S&P 500, so let's talk about that one. When you look over long periods of time, there are periods when they are not in sync, equal weighted and market cap weighted. And especially this year, we happen to be talking in 2023 in August. How do you think about that? Because then you might have a small group of companies, and it happened more often in the last 5-10 years than I remember before. Maybe I'm forgetting, where you had a small group of company, Nifty 50, obviously back in the day, where you have a small group of companies with massive market caps that basically move the whole ship in whichever direction they're going. Can you talk about that? Because when you have the 2025 and you have none of those 5, it's a different story.
Yeah, that's right. So our strategy is a high active share. It's over 90% persistently. That just means how much your portfolio is different than your benchmark, right? And again, if you're going to outperform, you have to do something different. And be different means you need to own something different in your portfolio. And so we have this high level active share. But what that means is that our relative returns to the benchmark, as much as we focus on how our companies are doing, the other thing is how are the companies that we don't own, how are they doing, right? And so there are years like this year where having concentrated strong performance in stocks that you might not own can be very damaging to your relative returns. I think that's an important thing to pay attention to. Like, so for instance, this year, understanding that, just round numbers, the market's up 20%, but the average stock in the S&P is only up about 10%. Mm-hmm. I mean, that's an important thing to understand when you're looking at your portfolio and trying to understand the performance of the stocks that you own. Understanding that all the stocks aren't up 20%, right, is important. But I think that over the long term, and that's where performance really matters, the S&P 500 market cap weighted is perfectly fine, right? You can look at the equal weight and the S&P 500 market cap weighted over like 30-year time frames. They have, almost identical returns, but you go through periods in which they swing around. And I think that's an important thing to understand. I think it's important for investors to understand why they're outperforming or underperforming, just to understand what the drivers are, right? And so I think this year is important to understand it. You don't own NVIDIA and you don't own Apple and Amazon and Meta. There might be that might be the reason why you're underperforming, right? Not just the stocks that you own, but the stocks that you don't. But that's never excuse over the longer term. The longer term, it's just, what are my returns been first?
You mentioned earlier in our conversation how when people were thinking about the economy during COVID and we were looking at the S&P 500, it's only the 500 companies, but there's so much business outside of those companies. But I'm thinking, and there are all kinds of metrics, how the weight, the representation of very few companies is so much bigger in the S&P, whether it was just tech, but not just tech, but the top 5 or top 10 stocks have such a big share in the S&P 500. And if I remember right, this is higher than usual and it's close to peak levels. Do you have some thoughts about that? Especially given that you pay attention to the benchmark itself, but the benchmark, the nature of it is evolving and changing. It's a moving target.
So I had 2 thoughts. One, if you have greater concentration of market cap value in the index, then to justify that, you need more concentration in the earnings power of the companies in the index.
Right.
And to be honest, it's completely reasonable to me to believe that there is more concentration of value generation occurring in the economy today. I mean, these businesses like Apple and Google, it's truly new for businesses to be able to have the breadth of skills that they're able to on a global basis and also be able to grow at the rates that these businesses are still growing at, right? And so I don't think that there's some rule, like some of you will say, well, this is the highest weight of the top 10 of all time, therefore it must go down, as if somehow the past was some like iron natural law that must be obeyed. It just reflected the degree of concentration of value creation. And I think it's pretty self-explanatory. People look around and say like, oh, guess what? Earnings has been concentrated in a relatively smaller number of companies in the past, and that might persist. For the most part, I don't get too worked up about those sorts of statistics. The other piece, though, I think is really important is we wrote a post, it was in 2017, called "Technology is Dead, Long Live Bang." and what we were saying was that all the great companies were being pulled out of the technology sector and being put in the communication services or consumer discretionary.
That's why I corrected myself, because I realized that these days a lot of those names are allegedly not tech companies anymore. So
yeah. And so the argument that we made at that point was that we showed that our portfolio was dramatically underweight the tech sector, as it continues to be today. But you look at the actual businesses that we own, they might be called, communication services, they might be called healthcare. But what are they? They're organizations that are leveraging and deploying technology in the service of creating value for their customers. And if that's not a tech company, then what is, right? And I even think that concept of a tech company is really outdated. Like, are there any businesses that don't use tech in theirs? Right? I mean, there was a time when electricity was relatively new that people talked about electric companies, right? Electrified companies, And so, it's like we used to call it .com. Well, doesn't every business have a .com URL that they own?
Everybody.
Right? So, for us, I think that the concept of a tech stock is just dated, honestly, right? And what matters is not how the people at S&P categorize stocks and sectors, but that you own businesses that are on the right side of future trends. And that you own businesses that are diversified according to their end market demand, not to however they're categorized by some people on it.
No, I think it's a really good point, but also the fact that we are living in a world of a winner take all kind of situation. And I'm curious about your thoughts about it, because the first book I read about investing was One Up on Wall Street by Peter Lynch. And he would mention that he would come across this new concept, usually a retail business, not necessarily, but in many cases. And it would be popular in one part of the US and then suddenly popular in half of the US and then coast to coast and maybe going global. And it was a story after story after story of businesses that we knew. US is such a big market. It's easy to test a new idea. If it works for the US consumer, it would probably sell in Europe and elsewhere. And there was a time when you would have a regional winner, a regional retailer in grocery store that would win. But then they became global, national. And nowadays, you don't have a Google of Argentina. You have Google. You don't have Apple of Thailand. You have Apple, right? Like you just have the same brands everywhere you go. And consumers want it because the US consumer loves it and they want it too. So it's an aspiration to have the phone and the device and use and be on the US launched social networks and so on. Do you have some thoughts about it? Is this the world where once you have a brand that works, it will be a global brand over and over again? Because it happened to Spotify, Uber, even Netflix is doing something remarkable that we've never seen before, where a very fragmented industry, where you would have even a release of a movie at different times, at different points in different markets. They're releasing their own production at the same time around the world. Do you have some thoughts about it? Is it a winner-take-all future?
I think it's very case specific. I think that what you're observing, I think the driver behind it is the way in which the internet has stitched together this global communication network. And that communication allows people to organize the activities of their business all around the world. So you said, you don't have like the Apple of Thailand and the Apple of India and the Apple of the United States, which is true. But Apple has employees in each of those countries. And really what's happened is, rather than the idea like, oh, this US company has somehow sold you all around the globe, is that the US company is not. They're a global company with activities all around the globe that are organized everywhere. And they just won all of those markets, right? And so the internet has allowed people to coordinate companies across, around the globe, but also coordinate customer demand, right? And interests, right? So today, people in Dubai and London and Tokyo and San Francisco often watch many of the same movies, wear the same clothes, drive the same cars, care about the same topics, right? And this is the global coordination of information, right? And so it doesn't surprise me that you have more of this kind of winner take all dynamic. But I also don't think that it is just something inevitable. It's not like capitalism is evolving this natural end state, winner take all in all areas. And I think that it's investors can be mistaken in thinking, well, all business will follow this path. And that's just not the case. I expect that over the next decade or two, we are going to see the rise of a couple disruptors of these huge, successful so-called winner take alls. And they're going to, I don't know, I can't tell a recommendation on which one that is. We're doing our best to stay out of them. But, there is not just this natural conclusion that all winning businesses just will go on.
Going back to the image that you left about the profits. So those big companies are big pools of profits that everybody is looking at, right? And Apple has a big pool of profit. And we're talking about numbers that are hard to imagine. There are a lot of people that are willing to take a little slice of that pie in various ways. And those companies will be probably vulnerable in the future. Sean, I could keep you here all day, but I have one last question for you about success. What's your definition of success on a professional and personal level, if you're willing to share? I'm curious how Sean thinks about success.
Well, professionally, we're stewarding over $1.5 billion on behalf of about 230 families and institutions. And success for me is the continued stewardship of that capital in a way that is superior to what some other group would do, what the average group would do. That's one way of saying outperforming the benchmark, right? But beyond just doing that in their investment strategy, it's also advising them, the advisors on our team do, and helping our clients understand their own goals and define their own goals and reach their own goals, which is not just about alpha in their equity portfolio. It's about a lot more than that, right? So professionally, I look back over the last 20 years and think about how we steward people through the financial crisis and steward them through COVID. And the periods that we outperform, the periods that we underperform. I'm proud of the work that we did. I think we've stewarded our clients' capital well, and I continue to steward it well over the decades to come. But to me, that is the professional accomplishment that I care about. I want our clients to reach financial goals, to be that helps them. Personally, listen, I'm fascinated by investing. I'm obsessed with investing. I get paid to study basically every little aspect of human culture and everything that impacts how humans behave. And that's great. But also I'm an individual in a network of relationships, and my family and my kids, wife and my friends and my coworkers, and personal success to me is really about those relationships, right? And doing and maintaining and developing incredible relationships.
I love the sound of that. Investing is a fun pursuit. People think of it as just making money, but it's a very intellectual pursuit. And the fact that you can make money by picking the right investments, it's kind of a side effect. But that you can explore new ideas, learn new things, get challenged. I think that's where the growth and fun happens. And hey, I mean, if you're right, you'll end up making money. That's a bonus. Sean, thank you so much for today. I learned a lot. It was a wonderful conversation, and I think we touched on so many different things and gave the audience a great idea of what you guys are about. And I will include everything relevant in the notes to the episode so they can explore more and follow you and read your regular articles. So thank you so much for today.
Thanks for having me. It was really a delight to be here. Great conversation.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski. The content of this podcast is for general informational purposes only, and so are the opinions of members of Seacard Associates, a registered investment advisor, and guests of the show. This podcast does not constitute a recommendation to buy or sell any specific security or financial instruments, or provide investment advice or service. Past performance is not indicative of future results. More information on Seacard Associates is available in its Form ADV disclosure documents available at advisorinfo.sec.gov.